We've got a full FarrCast for you this week. Jim Iuorio checks in with Michael Farr for insights for every investor to help you find your risk tolerance. Dan Mahaffee shares what he sees in the election results, and Michael welcomes one of our favorite guests, Shelby McFaddin, for an extended discussion on the markets, the economy, and where the cracks lie between and within them. I hope you enjoy the show. Now let's get to your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. First week of November here. We're coming down to the last 2 months of the year. Here we go. Around the 6th is when we're recording this week. I'm leaving for Naples, changing residence. It's getting chilly in Washington, D.C., folks, and it's getting chilly in the stock market. Things are beginning to pull back a bit. Not all that dramatically. You know, people are starting to wring their hands. Tech's had a couple of negative days. Bitcoin's pulled back close to 100,000. The dollar has gotten a good deal stronger and broken through some resistance. We're going to have Iuorio on in the first segment. I want to ask him about that. We're seeing precious metals hold up, all of that stuff holding up just fine. And the 10-year Treasury, the yield there is staying a little bit higher. It's right around that 408 number, 410 in there. So even though the Fed cut rates on the short end, we haven't seen the 10-year respond. Actually, it went up about 10 or 15 basis points in yield, which means the 10-year fell. And therefore, what brings down the short end might not bring down the long end this time. Bond investors are always seen as smarter than stock investors. What does it mean with oil at $60 a barrel? And it means that we've shifted so far from the focus on the Fed and what they're going to do, and the Fed is issuing sort of mealy-mouthed maybes for their December meeting, which means maybe, and they're giving caution that Wall Street doesn't want to hear. And then next, we shift from the Fed, because Wall Street didn't like it that much, to what are actually happening in earnings reports. And some of them are great, and some of them are good. But good is still getting you killed with your stock price if you're in tech land. Good is not good enough. So this is what you see when a market's had one hell of a run, and maybe some stock prices have ridden a wave of emotion to some new high levels that when confronted with numbers, investors feel a need to adjust, and they adjust lower. And they go, well, I'll take some profits here. Well, it's gone far enough. I don't know why it should go up another 10%. You come up with all of these wonderful arguments to take some profits and get some cash and make yourself feel better and probably pay 25% in capital gains. And I'm not sure it's the right move at all. Typically, I like to hold things for about ever, because in time they always come back. But people are worried now, and when I get worried, I talk to Jim Iuorio, the voice and face of the Chicago Exchange, and my great friend for a lot of years. Welcome back to the FarrCast, Jim.
Thank you for having me, Michael.
So I tried to give a sense of where we are as we still trade at these all-time highs and very expensive multiples, and yet are you switching to become a bear?
No, I'm not switching to become a bear yet, but I will say that when we get so stretched like we are, it's perfectly reasonable to come back down. I think in some ways, not only is it reasonable, it's actually welcome. The higher we get, the more stretched we get, the more I worry about the big one. And by the way, guys our age, we lived through 2001. Well, we lived through 87 too, but 2001 and 2008. And every time the market starts to turn lower, our head goes from a normal corrective phase into, is this the big one? Do I think it's the big one? No, but I will add something else. And that I've been saying this for a couple of weeks now. If you own the Mag 7 and you are not prepared, or let's just say the NASDAQ in general, and you're not preparing yourself for what could be a sizable corrective phase that takes it down 20 to even 30% within the next year and a half, 2 years, then I think you have too many stocks, and you're too much complacency, because it could happen. But I'm not saying it will happen. I'm just saying we're getting stretched, and we've seen this game before. You know what worried me the most, Michael? When OpenAI just started, everything they touched for about a 2-week period rallied huge. To me, it smacked of mania. It reminded me of .com, but .com was different in that nobody made any money. These companies make a lot of money. So am I worried? I will say I'm mildly worried, but I don't think it's the big one. Is that a wishy-washy answer or no?
Yeah, well, a little bit, yeah. But I mean, it's recognizing reality, which is, okay, things are expensive. They could correct. And some of these things that have gone up a whole lot could correct a whole lot before they bottom out and bounce. And this is the phase, Jim, for me as a very experienced investor. Jim, I keep looking around going, when you and I were younger, and maybe even young in this business, there were all those older guys we would look to during when things would get dicey and go, well, how is he reacting? Has anybody heard from John Merriweather? Who said what? What happened? What did Eric Gleacher say? I heard Gleacher talk the other. I mean, you go through the list and think, well, they're not there anymore, and now people are going, what's Iuorio say? What's Farr say? That makes me really nervous,
I know, I agree too, and it's a tough one to hold. But let's say this: what I have been saying over the last month is particularly with your tech stocks, you trim and trail, and you put in some protections. You don't get yourself too over the skis with greed. We have the saying is bulls can make money, bears can make money, but pigs get slaughtered. And that means that if you get excessively greedy, if you've been in NVIDIA for all this time, and I know capital gains taxes are ridiculous. So I'm hoping that there are people who have some of it in their retirement account and they can switch it without paying the government 20 or 29%, which is absurd to me. But you have to recognize when the stock market got a little crazy as far as stretch valuations. Could it get crazier? Sure, but it switches the odds to a corrective phase. So I think a corrective phase, well, we obviously have seen, 2%, which is not huge at all, but could it continue? I think it could continue.
The thing that we're talking about, ladies and gentlemen, is psychology. And the toughest thing you have to do as an investor is to fight the emotion, because the numbers are always with you. You can always go look at the numbers, and yet that's not enough, is it? And it's this phase as an older, experienced investor where I go, well, of course it's going to come down. I'm fine if it comes down. I can look at my own portfolio. And what I've already done, I've calculated a market down 20%. I've gone through and I've hit my stocks and I've hit everything and I've got a number and I know where that is. And I sit there with that number in my head on my whole portfolio, Jim, and say, it's no longer going to be $859,000. I know this thing can go to $700,000. I know it can go to 659. I've done the math, whatever that math is, and I've got that number in my head. And as long as I can stay north of that number, I'm like, nah, okay. But let me tell you what else I know about myself. Soon as I get close to that number, I'm going to be saying, holy crap, how much lower is this thing going to go? And maybe I should have sold, and and I'll just sit there and beat myself up and go, and then a year later, I'll go, well, that wasn't that bad, was it? No, you were throwing up on the floor. What are you talking about? Yes, it was that bad, but somehow I convinced myself it wasn't. Am I describing any experience that somehow feels similar to you?
Of course, 100% similar. But I will say something else is that back in 2000, that's when we hit the highs in the .com bubble. Nobody was talking about a bubble. Nobody was mentioning when the bubble would bust.
They never are when you're in a real bubble.
I know, but this time is a little different. People have been talking about a bubble over the last couple weeks, which leads me to believe that. And again, I think that the Mag 7 are in a bubble, but that doesn't mean the bubble is popping today. I think it could go on for a year, it could go on for 2 years. I just think that the fervor over AI is a little ahead of its skis. And by the way, remember when the internet bubble broke and those companies lost 80% of their value, what were we left with? We were left with the actual real technology, the actual internet, which was a real transformative thing. And I believe AI is too, but that doesn't mean that people can't get over their skis. The one thing I will say is that leads me to believe it's not a big bubble, is that people are talking about a bubble. As soon as I hear nobody talking about it and saying, oh, these AI stocks are going through the moon, that's when I will get more worried. So that's why I'm only mildly worried.
Absolutely. Okay. Tell me why I'm wrong on this, because you talked about doing some selling and pairing and making sure that you manage your positions and your risk, which I agree with. You also talked about adding some protection, which I don't always agree with at all. And here's why. A client was texting me yesterday morning. This is a very large client. This is well into 9-figure client. And he said, I'm nervous about the market. I talk to this guy 6 times a week. So, that he's nervous about the market. He's always nervous about the market. When it's high, he's nervous. When it's low, he's nervous. He's always nervous. So he says, I'm nervous about the market. Do you think we should go short the S&P? Should we do something to hedge? Should we do this or do that or the other thing? Should I buy some puts? Should I? And so I said, okay, let's, what I like to do here is do the math. Let's do the math. How much money do you want to invest in this insurance policy? So let's come up with the number, and let's say the market drops 20%. Let's say you're going to put with your 9 figures well over 100 million, 200 million, 300 million, 400 million dollars. Let's say that we could say we're going to take $5 million to hedge this portfolio. If it doesn't go down, you could lose the 5 million. Maybe we can put a hedge on even the hedge, which I know we can do. And then what's our upside over what period of time? Because then you've got to define a period of time if you're going to use options for 3 months. And then if we make that money and we deduct short-term capital gains off of that money, do you really want to do it? Because then how much of an impact is the 5 million going to make on the 300 or 400 million? And I know you're going to be throwing up on the sidewalk if you lose $5 million just cold because the thing doesn't go down and we've written it away. He's going to lose his mind on that too. So does that ring true? Because this is a really hard conversation.
Right. And here's when that conversation happens. It's usually when it's too late, correct? I mean, when all of a sudden, when the market volatility is shot up and we've lost 1.5%, we haven't got the big one yet. I'm just making up numbers. But that's when people who don't trade them every day start to talk about it. So I'm talking about a formulaic response. Like I've been putting on put protection because of valuations, because I believe where we are in the cycle. Have I lost money? Sure, I've lost money so far, but I've slept like a baby. But just because I know that I'm protected on the downside. But right now, I would say to people, once we start correcting, then you're buckled in, and it is silly probably to start hitting bids just because you're a little scared after a 2% pullback. So I would rather be in the stock market than just about anything else. Well, gold, silver, things that are going to, with the Fed coming to the rescue, because the Fed will come to the rescue. They even started that on October 29th when they started a little bit of quantitative easing again, or well, they got rid of quantitative tightening. So I think the Fed is still in our back, and I don't think everybody's leveraged up like they were in 2000. I don't know anybody who mortgaged their home to buy NVIDIA stock. So I don't think we have the firepower to make this a huge, huge correction.
And we did see that in 87, and we did see that in 89. There was another crash in 89. People don't talk about that one, but that one sucked too. It wasn't quite as big, but that was, I mean, that was a gut punch in 1989 because I still remember it. And yeah. So let's go back to stocks that have just rocked way higher, Jim. Let's say that I bought it, and let's say that I own it just for illustrative example purposes. No recommendation to do anything with it, ladies and gentlemen. Some stuff's just gone up a whole lot. I mean, there are a bunch of them, right? I mean, there's all of these things way, 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 way up, and arguments that they're going to keep going, even though Michael Burry says they're not going to keep going. Look, he called one top. It doesn't mean he can call two. Don't ever forget that.
He's tried to call 10, Michael. He's tried to call 10.
I know, that's my point.
And he got one right. And the one he got right was amazing. You know, I bowed to him, but he's called 9 others.
Hey, you remember Elaine Garzarelli?
I know the name, yeah.
I'm sitting here flipping my hair, ladies and gentlemen. Elaine Garzarelli, I got to know Elaine. We were on Wall Street Week together years ago. Elaine had this huge mane of hair. It was magnificent, but she knew it. And she was always flipping it and fooling with it and everything. She called the crash of 87. She called several thereafter. And she called a couple of bottoms in there. She'd never called a bottom before. And that was it. She was a one-hit wonder. You get it right once, which means you get it right once. Good for you. Okay, what do I need to do as an investor? I need to stay invested. I need to own good stuff that goes for the long term. This AI stuff is adding productivity. Is it adding enough productivity to justify its prices? I don't know. I love the prices, but I don't know. The market tests these theories every day, and it'll go to excess and it'll find the right level. I don't know where that right level is. But what I'm seeing is maybe even something higher than Moore's Law, Jim, on AI, okay? Moore's Law, ladies and gentlemen, basically said that new technology will double about every 18 months. We saw it especially in chip speeds. We also saw it in fiber optic speeds. We saw it in all of these things that were increasing, right, technology and the use and the efficacy and everything else. 18 months, stuff would double. Seems faster, Jim. What do you think?
I think it seems a lot faster to me. So I think that everything else seems faster too. Even people like access to their portfolios. Everything used to take days and now it takes minutes. So I think that that's probably condensed. There's something I'd like to tie up that people think maybe I said something that was inconsistent because I said I do think the Mag 7 should have a 30% pullback in the next 18 months. And at the same time, I said a huge broad correction, a huge broad bear market, I don't think is in the cards because of the lack of leverage. But I will say this is that those stocks in the Mag 7 have gone parabolic. When you are playing a game that is high stakes, you have to allow for yourself to have this 30% pullback, which by the way, they've moved, 10% in a week, 20% in a week quite often. So 30% pullback in those names is not a big deal. Then you have to ask yourself, is that enough to pull down the broad market, the 30% with them? Probably not the 30% with them, but to see a 10, 15% correction, which creates a buy opportunity in the broad market, I think is very, very reasonable. And I think that we could see that sometime within the next year.
I'm hearing in the back of my head our listeners saying, Iuorio, Farr, I hear you, but I'm still nervous about this market. I'm still looking at these numbers. I'm seeing stuff come down, and I just don't like it. This doesn't feel right. Well, it doesn't feel right. It does feel right for a market that's getting ready to correct. Now, it might not. It might not get the 10%. It might not get the 20%. This could be just a blip, and we could bounce from here. If it does, it feels right. No matter what happens here, it does feel right. Iuorio and I are both telling you the same thing. So's Kenny Polcari. This is the way it feels before a market corrects. Okay.
And
This
by
is
the
the
way,
action you see.
and Michael, an average, I know we had the correction on in
Yeah.
April 2nd, but
Yeah.
it's average that we have a 14% correction
Yep.
per year.
Per
So
year.
I mean, this is not the most. In some ways I welcome this. I plan on picking up stocks cheap when they come down.
Yeah. Well, but what I want to tell those listeners who are going, I just don't still feel like I agree with you. You do actually. If you still feel uncomfortable, you agree with us. You do it.
The uncomfort is the thing. It's the
Yes.
frog, right?
Yeah.
Yeah.
Yeah. You feel uncomfortable. Listen to Harry Jennings. Don't just do something. Sit there. Because markets go down. The thing that Jim and I will do is we'll not go out and sell into a down market, and we're not going to take and pay capital gains on stuff. Basically, you're trading an absolute known tax consequence for a potential loss, and that potential loss you also have to say is never going to rebound again. If you're really convinced that's going to happen, then sell the damn thing. But if you think that some of these stocks, but if you don't think they're going to bounce back, okay. But I think some of those companies with trillion-dollar balance sheets are probably here to stay. I'm going to keep owning them, and I'm going to stay the course. Iuorio, what are you going to do?
I'm going to stay the course too, but I like, I'm a huge diversification. I'm a risk mitigator. I think if you're not exposed to things like gold, silver, which will do well if there's some sort of chaos in the next couple months, and then the Fed comes in to add liquidity to the market, those things will do well too. So I believe in diversification. I believe that discretion is the better part of valor. Am I exposed to the tech stocks? Absolutely. That am I licking my wounds this morning? Sure, but I'm looking more to pick those things up because I wasn't too over my skis to begin with.
You always say the right thing. Honest to
Thank
God,
you.
you always say the right thing. I sit here and listen to you and go, I should invest money with this guy. He's really smart. And he says, he always says the right thing. I love it. I love it.
Soon I'll talk to you about my model portfolio that I've been working on, back testing it for like 80 years. We'll talk about it another time.
As soon as you put your money in it, I'll put mine inside along with you. How about that?
Done. Right. Okay.
I'm in. I'll invest with you. I absolutely would.
All right. Because you can open a friends and family fund, right? We'll talk.
I might manage some of yours too. In my
Good. I'll take that. Yeah.
PJM Institutional Services, Jim Iuorio, and my hero. Thanks for being with us. We're coming back with Mahaffee on the FarrCast.
Thanks for being with us on Season 9 of the FarrCast. And now, political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back to the FarrCast. Joining me now, as he does every week, except for those few weeks when he doesn't, 9 seasons of the FarrCast, Dan Mahaffee. president of the Dr. Scholl Foundation, a scholar at the Center for the Presidency and Congress, study the presidency and Congress, a Washington, D.C. think tank, and the senior political analyst on the FarrCast. On this post-election morning in November, Dan, welcome. We're glad you're back.
Good morning, Michael. Thank you. Yes, post-election day, yes, looking at the results from New York City, Mamdani, the results too from New Jersey, Virginia, and of course, California deciding to go ahead with the gerrymander. Yeah, Democrats, I think, are feeling certainly more excited, glimmers of hope, I would say, that were not previously there. But when we break down New York City, I think a pretty stunning result there to consider that this fellow went from a state legislator to now mayor of America's biggest, most dynamic city.
I saw an interview of someone in California who'd left the polling place who just voted, and they asked them. They said, "What if this passes and these districts change? What if Mamdani wins in New York? What if the Democrats carry the day? What message is that for President Trump?" And this person looked up and said, "He asked for it."
Well,
I thought it was, he asked for it. Do you think that's fair? Is that, it's glib and you can kind of chuckle at it, I know. But how much of this did the president bring on?
that's a good question, Michael. I think, look, in New York City, I want to set that aside because it's so different politically from the rest of the country. We have to be frank and honest about that when we look at these results.
California's not, though, Dan.
No, and California is certainly not. California is not. And look, that is where you have, though, a lot of anger about the economic uncertainty. California is a state that is we all know is a trading state from its farmers to its biggest companies. And it's a state of immigrants. So in all those areas, the president's policies have disrupted. But, frankly, look across the map. If the choice is, Michael, if the choice is MAGA or Mamdani, I'm sitting here looking at my passport.
Wait, if the choice is MAGA or Mamdani, I'm looking at my passport. You know what, Dan? I'm going to leave that one alone. I think it speaks for itself. That's pretty funny.
But no, I think, Michael, to be fair, if you look at the exit polls, a lot of the data is saying, Mr. President, the economy is not doing what you're saying. What we are feeling on prices, you're saying this is everything of your policies is making America back to this, golden age. And that the voters are saying we're not feeling that. The voters were saying we aren't feeling the same good economic vibes we remembered from your first term. And as much as you want to, Mr. President, if you want to spin this, look at what happened to the last guy who said that the economy was great, even as the public told him it wasn't, because President Biden tried that and it did not work.
So we're back to James Carville. And it's the economy, stupid. And this is is this a mini midterm repudiation? It's hard to figure out how you have a repudiation after 9 months or 10 months, 10 and a half months in office, though this president has accomplished 2 years worth of policy decisions and activity. I think he's done 2 years in these 10 months. Mm-hmm. So 2 years and 10 months has got people's full attention. Is that what this is, this vote? Is it both policy and economy, or how do you divvy it up? And what do you think? We saw an angry response from President Trump late last night. What do you think is the president's response going forward? Does he heed these messages, or does he barrel through and say, you all just sit back and watch this. I'm still in charge and I'm large and you get out of my way and I don't care about these little elections or you little people?
Look, I think he's going to continue to barrel ahead. It's the only strategy we've seen him pursue. But look, we also know how politically astute he is to be able to, as we've seen countless times, somehow pivot while still moving and barreling ahead. So what does it seem to be that he tries to become a deal maker on this government shutdown? I don't know. Again, his remarks yesterday on the nutrition program seem to be digging in there rather than looking for any kind of conciliation. So Again, right now, as you say, yes, it's early. What they'll be saying in the White House too is, look, these are all blue states. This is New York City. This is not where 28 or 26 will be decided. That'll be what they will say about these results, and those are fair statements to say. But the sentiment you still see, and again, where if you looked at the polling data, where again, and they said where New Jersey, they wanted to have a close result in New Jersey. They thought that was in reach, and it was still way behind. Again, the Mikey Sherrill did very well against Chitterelli there, and doing so, that showed that the independent voter, the ones who said, "Look, we are," in 24, they were tired of the Biden economy. They looked at all the things the Democrats were saying, be it Trump's rhetoric, January 6th, immigration. None of that mattered because the economic message was not landing, and President Trump was giving them a more hopeful ticket. And right now, those independents are saying they're not seeing that.
I argued during President Biden's administration that the economy was doing reasonably well and that he had some of the worst sales team on creation. It's because some of the data, and when you looked at the data were expanding, things were improving, and there was money flowing. There was a very good story to be told, and you have to do more than just say, "Hey, isn't it great?" I'm sorry, isn't it great doesn't do anything. You got to show me it's great. You got to bring in Joe the plumber. You bring in Joe the plumber, you put him up on stage and you say, "I'm better," and get Joe to say, "I'm better off." That resonates. We didn't do anything that resonated. So I think it was a twofold problem there.
And Michael, I'll add finally that having had so many decades politically of a low inflation or non-inflation environment, to now be in an environment where cost of living is a major issue among voters, a lot of the political parties of both sides, I think, are caught flat-footed by this in their economic rhetoric or sales, as you put it, because for the voter, number one, it's the cost of all these items, eggs, gasoline, housing, etc.
Yep.
And they're not going to care about any economic metric you throw out there, tariff rate or whatever, when those are the things they're complaining about.
No, but the thing that Biden had too that he didn't use, Dan. Yes, we had all of those things for the consumer, but the consumer also had a larger paycheck. The average American saw that inflation hit the paycheck and it went higher, and that would have been the thing to emphasize. Show them ways they could afford more than they could before. You show them the baskets and the everything, and show them their net paycheck and say, "You're still able to go on a vacation you couldn't. You're still able to do this and you couldn't before." That's what's happened under my administration. It's context is so important. Where's the real truth? The real truth is that basically happened, but it was a marginal increase. It wasn't a dramatic, and that's what politicians do. They make the marginal feel dramatic when it's to their advantage, or dramatically bad when it's to their advantage. But whatever they say, you can count on it being to their advantage. All right. So, Dan, what does this mean for President Trump, his ability to get out of what he's gotten himself into in Capitol Hill with this government shutdown? I continue to be cynical and say he's going to let it turn into more of a crisis so he can posture as more of a hero when he comes in and solves it.
I think there is the fact that he could do that very well. We've seen him do that with past crises like this, build them up. But I don't think that. I think he right now is seeing this as pain inflicted on the other party, even if the polling numbers don't show that right now. And again, he will say, who among my base, and there will be evidence to the contrary, but at least the sentiment of who among my base is being hurt by this, who among my base is blaming me for this.
Okay, let's go to the Supreme Court. I think it's the most important thing happening in our country right now today. Not the elections, folks. Not overseas, not the shutdown. What's happening in the Supreme Court, and this decision they make will be one of the most transformative moments, I think, in several years. Tell me I'm wrong, Dan, or if you agree with me, explain at least what's going on Capitol Hill. And I'm saying on Capitol Hill because the Supreme Court sits on Capitol Hill. It's right next to the Library of Congress. It's dead in behind the Capitol and dead between the House Office Building and the Senate office building, sorry to say dead, directly between. Go ahead, Dan. That was a real
Well,
bad. That was
that's the
a
Freudian slip there.
really
Yeah.
bad malaprop, by the way.
Yeah, but well, no, look, Michael, it's a very important case, and I think you're exactly right about it because as we've talked about the institutionalists or idealists coming down to the separation of powers, in this case over tariffs today, and whether the president has the authority to unilaterally uh, set these tariffs, particularly claiming emergencies. And as we've said, look, Michael, you and I are skeptical that the Canadians hurt my feelings rises to the level of national emergency. But that is how the policies have been used thus far. And frankly, on the matters of tariffs and taxation, it is clear what the Constitution says, that this power lies with Congress. And yes, Congress has written legislation to allow tariffs to be put in place during economic emergency. But the case that we have here is basically one that will say, one, whether the separation of powers matters. And if the court feels that it doesn't, and the president can go ahead with the rules that Congress has written, then the court has likely said that basically Congress ceases to exist with its power of the purse. If it's willing to hand it over to the president like that, then the court will basically have signed, I think, the end of Congress as an independent institution when it comes to matters of trade and taxation.
What will the court do, Dan?
I think the court really is hard to predict. What I will say is I think they do try and limit some of this emergency power because, look, I don't think they liked it when Biden tried to do it with student loans, other things like that. But the solution, though, I think they really limit it to the specific firms here that have sued for relief and try and make it into some kind of process where each firm gets relief. But I think that's going to be messy in itself. So they're going to try and find some solution, but I worry that it'll be more economically messy than clear.
Dan, with the redistricting of California, in response ostensibly to the redistricting of Texas that gave the Republicans more seats. Now they're doing this. Once that door gets open to, I'm going to start doing this sort of stuff, when is it appropriate for the president to say, I'm going to stack the Supreme Court, or I'm going to continue to push for that nuclear option he discussed for getting rid of the filibuster rule and going to a 50 vote, going, as long as I get it from my administration, we'll be fine. And I've got 30 seconds, Dan.
No, Michael, yeah, that is definitely it because it is the race to the bottom once you start gerrymandering like that. You take away all the different blocks on, be it the filibuster, all these sort of institutional blocks, and yeah, it's a recipe for one party rule down the road.
There's no safeguards in place, Dan, unless Congress stands up and, to me, does its job.
Right, and well, they're not even coming back, at least half of them.
Quickly around the horn internationally, take me from Russia, China, Israel, please, Venezuela.
Yeah. Russia around the horn. Russia's again still trying to push really hard on the Ukrainians, trying to maximize again the mathematics of how many $500 bombs can we throw at them shooting back with $1 million Patriots, and the Russians continue to believe that math is on their side and want to target Ukrainian heating, electricity, all that before the winter gets cold. In the Middle East, again, it's not only is the pressure on the Gaza ceasefire to hold, but you also have the pressure on Lebanon. Will Hezbollah disarm? That's a big question I'm monitoring because that deadline is coming up for the Israelis. And look, the internal politics, we don't have time for the internal politics of Israel right now, but given the post-ceasefire dynamic, the recriminations over the fault of October 7th back then, all that still remains. So, tenuous ceasefires holding there. And then back to China, I think, look, we saw no negotiation over Taiwan or things like that. So while the economic flashpoints maybe are put off for a year, still got to look at the South China Sea. They're building those islands. They harass the Vietnamese, the Philippines, and et cetera.
Yep. And Netanyahu just keeping himself alive.
Yeah, largely, and I think that's the back and forth among these coalitions of his. But look, there's to really get in the weeds right now. He's surviving because most of the attention is on a scandal about the mistreatment of Palestinian prisoners.
We had Admiral Terry McKnight last week, and he was talking about the rules of engagements. I wish I had suggested that. I bet he wished he'd known that many of those pirate ships in the Gulf of Aden were carrying drugs. That would have been all he needed to know, right?
Yeah, and that's again, yeah, we see what rumors that the president is now looking at options for airstrikes in Venezuela. So that is being discussed within the administration, according to reports.
Dan Mahaffee from the Dr. Scholl Foundation, and believe it or not, a scholar at the Center for the Study of the Presidency in Congress. Our senior political analyst on the FarrCast and my dear friend. Thank you, Dan, very much.
Thank you, Michael. Have a good day.
We're going to get to the economy next on the FarrCast. Please stay with us.
Thank you for joining us on the FarrCast. And now, back to your host, Michael Farr.
Welcome back to the FarrCast. I'm Michael Farr. Joining me now, a FarrCast fan favorite, Shelby McFaddin, and she's a Michael K. Farr favorite too. I think she's awesome. Chief strategist for the Motley Fool, an economist, and just a brilliant but a really nice person on top of being just brilliant. Hey, Shelby, welcome back to the FarrCast.
Great to be here. Thanks for having me, Michael.
That was my fourth take, so everybody's smiling and laughing here as we're looking at each other. It took me 4 times to get that down. Sorry, folks. Okay, and sorry, Shelby and Harry. Here we go. The Fed weighed in, Shelby. We were talking about this. They lowered as expected, and then they gave us some mealy-mouthed stuff about December, like maybe it's enough, maybe we don't know, maybe we're going to back off. And to me, they reiterated this notion that they're trying to right-size and normalize rates as opposed to become accommodative or stimulative. They're just trying to get back to the right point of equilibrium. So this is not the economy's in trouble, it's anything but. But Wall Street really doesn't like hearing that, and I'm pretty sure President Trump doesn't like hearing that. What did you hear?
I heard the same thing that we've been hearing. What's interesting is how quickly the market forgot that this is how the Fed has always been. As soon as the Fed started taking action, it was this great surprise. Why is he too bullish? Why is he too bearish? But it's suddenly forgotten that we went through years where we were just waiting for them to make a move. I remember waiting for them to stop hiking. Everyone was terrified. Then we sat and waited for them to do something. It was hold, 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 hold. And the explanation was always, we need to see the data. Well, the Fed is getting a little bit less data now. They're having to use more private sector data. And frankly, the data that we're getting in the open market is the CPI data is the most valuable to us at this point. We're all very grateful that we can still get that. So they're working.
Do you believe it? Do you believe the CPI data?
I do until they revise it. They always do, right? So we'll see what we're going to get from that. But I believe it's reasonably within range. But the idea that the Fed would be less data driven, especially now, when we have some that believe that they're a little bit too late, others believing they're a little bit too early, and they're trying to be right on time, they're going to be more data driven than ever. We want them to remain independent. Most of us do, including myself. And so if that's the case, then they're not going to base their decisions and their actions off of what they think might happen with any sort of fiscal policy. They have to wait for those outcomes to come into the market. So if that's the case, they're going to continue to wait on data. I think this is not shocking at all. I think this is about normal for them. They don't want the market getting ahead of itself. Not too much they can do to stop it, but I think this is normal behavior for Chair Powell.
I mean, Shelby, can you imagine having a major decision to make anywhere in your life and saying, you know what I need? Less information. You know what I need? Less data. I don't want to be confused with all of this data. Why don't we just go with how I feel? Oh, yeah. Oh, that's great. Oh, there's a good idea. Jay Powell's trying to say, I can't anticipate what the economy is going to do. I need to look at real numbers because I know that I'm human and fallible and I'm very likely to guess wrong. Even when I'm looking at the numbers, I can come to the wrong conclusion with some of the most brilliant economists surrounding me. This group can still lead to the wrong place. So more data to a point. You can be overwhelmed, but to a point, I think is absolutely necessary. So bring us back just down to the basics here. Economy still expanding, consumers still somehow healthy, but boy, the division among consumers still seems to be growing and growing and growing among the haves and the have-nots. And the have-nots feel like they're being left out, whether they really are or not, whether they're really seeing wage gains or not. Certainly, SNAP for the bottom part of our American cohort is making a huge impact. Though I've been very encouraged to see a lot of responses online and other places. I contributed to a group that was putting together meals to make sure that people on SNAP in their area would not go without, that we would rally around and we'd make sure we were provided and make sure that people didn't go hungry, and children and everything else.
Yeah.
Where do you see the economy? Do you worry about this divide? And what's worrying you now? Or do you think we're okay?
This divide is something that had a bit of discussion before the hour. It's something that if you are into the financial markets or studied economics, you knew it was likely to come when the economy first shut down in 2020. You knew that something wasn't going to go quite right. Then when the checks started coming, there was also that sneaking suspicion of we're going to pay for this, right? This inflation is going to come back to get us. Lo and behold, about 2 years later, we're all saying it's transitory. Even myself, I'm going to go ahead and crucify myself there. We all said it. It wasn't
That's
transitory.
not crucifying yourself. A lot of it was transitory. The supply chain stuff, the ships sitting off of ports, all of that led to price increases was indeed transitory, and it did indeed clear. It just didn't do it. It didn't do it on the calendar that we had chosen and we're sort of partial to. Well, big whoop. I mean, it never hits the calendar, right? If you want to predict, just don't ever say when. And everybody says, oh, isn't that cute? No, it's common sense. And we keep shooting ourselves in the foot over and over again when we insist that we're going to know when. We don't know when, but it did clear. So you were right, Shelby. Don't criticize yourself.
Well, thank you for salving those wounds. They've haunted me a few years now. But either way, we knew it was coming, right? And it did show up. And then the checks kept coming. The relief kept going. And we figured, okay, there's a lot of cash in the economy. The interest rates stayed low, right? So you look around and you realize that there are cohorts that are spending in a way that they haven't been able to. They're consuming in a way that is unfamiliar to them. And there's the behavioral element, right? The money eventually goes away, but the behavior is really hard to change. And so when you have that sort of bifurcation, you end up in the situation we're in now, where slowly over time, the lower income cohorts have had to change their behavior a bit. Things like Afterpay and being able to prolong it have stretched that out. But slowly but surely, they got back to their needs, while upper income cohorts have been able to continue to coast on what they need, what they want, and then some. So when we look also at the data sometimes obscures it. Oftentimes, it's just looking at zip codes, right? And so things get obscured. It looks like everyone's doing okay. But when you really dig down into it, you start looking at self-reported income when you're really diving into sort of smaller barriers that economists will use when they're doing these sorts of studies. The picture's not so rosy. The bifurcation started a lot earlier. So we saw that come through in credit along with spending. And I think that's one of the reasons why now people are saying, why do the banks look so good? They did their work, right? They know what it looks like.
Yes, good answer. I love that.
They stayed on top of it. They have been here before. So I'm not shocked when every quarter, first week after the quarter ends, the banks are like, we're actually doing fine. They know what it looks like when they don't. They know how to do this. This is not their first rodeo.
Shelby, I'm going to confess myself, and I'd like to go back to the beginning of COVID, because the beginning of COVID, I was at a dinner, and I was at a table with the CEOs of two major publicly traded companies, and it was pre-COVID, and the chairman, a CEO of one of the largest automobile companies in this country said, and I hadn't heard about this disease, COVID. Nobody had. This was in January of 2020. Said he was talking about it with the chairman of another large publicly traded company and CEO and at this dinner. And he said, yeah, we're going to have to stop production probably in 2.5 weeks. And he kept talking. And I said, wait. This motor company is going to have to stop all U.S. production? In 2 to 2.5 weeks? He said, yeah. I said, why? He said, this disease in China. I said, disease in China is going to stop U.S. auto production? He said, this area of China is a manufacturing area, and I can't sell a car or a truck without a cover or a latch on a glove compartment. I can't. I can't just say, well, we'll send it to you later. And by the way, door handles and this and that. Because that area is going to shut down over this disease, I've got to stop production. So we had a sourcing problem that was entirely focused, and we were hit with this, unicorn of a problem. And when they went through what was going on and they were going to have to stop at their companies, I freaked. I went straight to CNBC and I said, look, there's this thing going on and it's going to be horrible. And I was one of the first people who got out there and did it. And it's because of who you know and what I was able to learn. Here's my confession. When it really started and everything shut down in COVID and people stay home and we're not going to do this and we're not going to do that and we want you to shelter in place and COVID tests and we're going to come through all of this stuff, and the stock market started to drop, and I looked at the economy and I went, oh my God, the U.S. economy and the banks and the everything, and we had this big 20 or 25% drop in the stock market. I thought, this is really it. This is going to be a major depression. Yeah. And logically it should have been, but I really got scared. I got married to my own view, and I couldn't believe what the Fed was going to do. They sent money to people at home. They sent money. They just put checks in the mail. No, we're going to send people money to keep this thing alive. They did entirely the right thing. Somebody went, they broke the glass, they rang the bell, and I was sitting there, and the market rallied back, and I'm sitting there now getting angry, Shelby, going, this makes no sense. Right. I had this right. I saw it. I knew what should happen. I knew the economic answer. What the hell are these people doing? They shouldn't be able to fix this, and they fixed it. You know, I don't know, for those of you who read the Bible, but I felt a lot like Jonah sitting on that hill, ladies and gentlemen. I was all ready to see Nineveh go down. And then, and I had the answer. So I was feeling pretty smug. I was sitting there under my big plant in the shade of it going, well, look at me. I'm pretty good here. And then a worm came overnight and ate the plant. And I was ready to curse God, I'll tell you right now. Anyway, I didn't do anything about it. So I didn't go out and sell stuff. But damn, you can get some of the most obvious, seemingly obvious things completely wrong. Shelby, is my lesson and my apology. We could be getting wrong everything we're looking at today, and we need a Fed that's going to look at data. And even with the data, I bet if I had talked to all of you listening to the FarrCast right now and shared what I did, well, I did share most of it, and I bet most of you were persuaded by me and convinced by the same things that convinced me. So we can still get it wrong, which is why we have to go back to our discipline.
My only comment would be, I don't know if you got it all the way wrong, because look where we are now. It was fixed, right? It was a salve, sure, but we're now sitting in this situation where our economy is not being led by any of the things that we thought would lead the economy. We don't have this massive jump in sort of service-related work. If anything, we've had a bunch of service layoffs. We haven't completely sprung back in manufacturing or mining. And now we're looking at essentially data center growth at being really what's plugging the economy along. So maybe you called a little early, but your suspicions that led you to movement, I don't think were wrong. I think deep down, the concept that things were going to be very different is where you were right. The degree to which they might be negative is where we could look back and say we missed it. But I don't know. I think that you knew that something this significant couldn't leave us exactly the way we were before. I think that's what you were right about.
Do you see why I love this woman? Huh? Do you all? I mean, I'm telling you, I am 100% smitten right there. She says I wasn't that wrong. How about that? I don't have to feel as stupid as I did before. To her point, I will point out one thing that I think is really important. The fix that they came up with has left us with 37 and soon to be $38 trillion in national debt that is increasing at a remarkable pace. We are borrowing money day to day from future generations, and we're all under this sort of assumption, and I think false assumption, that these chickens will never come home to roost. Bull. They will. They will. I promise they will. And the only answer out is inflation. The only way to get rid of this much debt is economists use a word that's just so lovely and erudite. They say we're going to monetize it. We're going to monetize the debt. Doesn't that sound nice? Doesn't it sound like, oh, let's monetize it? I don't like inflation. I don't want to talk about that. But I like this. What's that word? Monetize? Let's do that. Okay, look. We're seeing evidence of that in just the numbers we've talked about already. Prices have gone up. You've seen it during COVID. You know what a pound of butter costs. Your payroll has gone up. Your checks have gone up. Everything's gone higher, but your higher checks aren't really buying that much more, maybe a little bit more. So what are we really doing? We're inflating both sides of the balance sheet, but that's all we're doing. We're giving you more money, and we're going to charge more money, and we're going to make this go up. And when we inflate, we lower the value and relevance of the debt. That's how we do it. And by the way, all economies, all societies over time tend to inflate the value of their currency to zero, to zero. And we can go to Greece, we can go to Rome, we can go wherever you want to go historically, and that's what happens over time. So, Shelby, presuming we're somewhere in the lifetime evolution, Shelby, what about AI? I mean, AI adds a whole lot of productivity. If you look at GDP growth, it's the combination of labor hours worked, and head count in the workforce, and productivity. And we know that the workforce and population is not growing. And in fact, with the immigration policy of this administration, it's probably maybe even going to shrink. And we're seeing layoffs too out there. So unemployment could be on the rise, not dramatically, but perhaps on the rise. ADP numbers this morning were a little bit more positive. Maybe it's not the crisis we think. But AI, the productivity coming from AI, could it be so significant that we're underestimating it? And that we certainly know it's what's been driving some of these stock prices higher, but for the economy, could it be the solution to growth, to exponential growth? Could it be the cure for markets and the economy that we're all looking for?
I think with AI, we're probably estimating it close to right on, but the runway is too short. So there's still a lot we're not sure about when it comes to AI. The utilities right now don't even have the bandwidth to get the most out of all of these data centers. Between water and electricity, we're not even seeing how much we could do. So I tend to believe that we are closer to pricing its full potential. The issue with that is that the market believes it's pricing its 3-year potential. The market believes that there could be even more than this. The issue is we don't have the full fundamentals yet. We're not entirely sure what we can do. So it's hard to say that we're overpricing because we don't know the barriers. So I tend to lean to the fact that we are about pricing it right on, but we're pricing it too soon. I think we're more so pricing in all of the sort of total factor productivity benefits that we're going to get from it and expecting to get them within 2 to 3 years, as opposed to getting them over time. There's still a lot more legislation that has to come through for us to be able to maximize this capacity. Because if we want to geek out, and I know I'm trying to keep it tight, but if we want to geek out and we look at the GDP equation, understanding that this is going to have an impact on the capital component and the labor component. This is something that is unique in that way. And so it absolutely is going to just expand also total factor productivity through the roof. It's just how long is it going to take?
Not only a brilliant answer from my friend Shelby McFaddin, but it sounds like she's from Missouri. Show me. That's what they say in Missouri. Show me.
Yep. You have to.
What are your concerns right now about the economy? Do you think the Fed's doing the right job? And do you have any advice to investors and our listeners? And I'm going to end there because I always love talking to you. And I learn so much whenever I talk to you. but let's bring it home for the investors because I could do this all day.
I honestly the same. When I meet another econ nerd, I could just sit down with a big water bottle and a coffee and be there for weeks.
All right. Well, sign me up for that. Harry, sign me up for that. Let's do that. We can even record it.
I think where we're headed is unfortunately a slower road than we might like. It's much more gratifying to be able to see the end of the runway, but I fear that we may still be paving it with asphalt. So where we're moving is a continued bifurcation because when we look at what companies are doing in response to that tandem wage growth, it's layoffs, right? It's slowing down. And the other reason for those layoffs, we know, of course, is to offset a lot of the capital investment that's going on at the top in the tech most parts of the economy. But we have seen companies react to the cost of labor by reducing labor. So I do think that's sort of part of stage one of saying how long can we grow in tandem. Now, that's the private sector. The government can, of course, do other things to continue to inflate the currency, right? So trying to inflate our way, as you said, out of debt. So the private sector is saying, we'd like to mitigate this if we can, but then you still have government. So the question of how long can consumers maintain this before sort of, as Harry and I sort of chatted before the wealth effect doesn't work anymore, could be years, could be a decade. How long can the upper crust sort of subsidize? It's going to be a while. So if we want to separate the macroeconomy from the stock market, I would say it's this. I would say that the stock market in and of itself seems to have a much rosier picture of where the United States is going, just looking at the US stock market and looking at the opportunities. Is there an insane amount of concentration? Absolutely. However, knowing that rates are probably coming down and with much of the market wanting rates to come down, it's unlikely that everyone would flock back to cash, right? So there is still a great breadth of reliable, large, mid, and small cap names to absorb some capital if people get spooked in large cap. So I don't think that we're heading into a situation where if we do hit a bump in just the stock market, people would leave. When you could get 5.5% on your cash, yeah, people were just out. They're like, you know what? I don't want to be bothered with this. I'm just going to do cash. But at this point, risk assets are where you want to be if you're seeking any sort of accretion to your cash. So there are more places to go in the stock market. I'm less concerned about a flight from risk assets. When it comes to the macro economy, I think we're going to continue to see that split in consumption. We're probably going to need to watch things like durable goods consumption because folks are going to be less likely to go out and buy a Ford Bronco when the rate is no longer 3%, right? When your credit score is really starting to matter. And with things like, I know I've got a million tangents, but this is how economies work. I think we're probably going to continue to see a bifurcation within the macroeconomy and a bifurcation of how the macroeconomy is doing versus the stock market. Unless the stock market decides to care, again, about macro fundamentals, I would imagine it continues to go that way. So for investors, patience, discipline. One of the things we said,
this is going to be a volatile time. That's it. She didn't say
yes.
We're not going to be volatile. She didn't say it can't go down 20%.
Nope.
It can.
When it does go down 20%, what matters the most is time in the market, not timing the market. You have to just be there so that you can wait for these things to work themselves out. And when you're already there and it's down 20% and you already bought at a place that you were happy and you've been watching the market, you've been vigilant and disciplined and not letting your emotions rule you, you get an opportunity to buy. Not always every name in your portfolio, but something opens up. And so sitting there, watching your portfolio, not every single day, but being aware of what's going on, taking in the news, but filtering out the noise, it really gives you an opportunity in a volatile market. And that's the whole point of being active. You're going to sweat a little bit, but usually it pays off.
That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world, bringing you insiders to help us all better understand, and certainly me included, what's going on in the world around us, around the globe, and how it's going to affect our economy, our lives, and our investment portfolios too. Hope it helps you, helps me a lot. On behalf of my producer, Harry Jennings, everybody at Hightower and Farr Miller and Washington, I'm so grateful to each of you for listening each week. Please share us on your social media. Our audience is growing, and that's wonderful. Thanks. Comments, questions, hjennings@farrmiller.com, hjennings@farrmiller.com. In Washington, D.C., on my way to Naples, Florida tomorrow. Thanks so much. I'm Michael Farr. I'll see you next week.
And that's it for another episode of the FarrCast. Thanks to this week's guest, Jim Iuorio, Dan Mahaffee, and special guest from Motley Fool Investments, Shelby McFaddin. And thanks to you, our listeners. We hope you enjoy the show as much as we enjoy making it for you. FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Apple Podcasts, Spotify, and TuneIn. Please be aware that any time we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And if we can be of assistance here at Farr, Miller & Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'll be happy to put you in touch with one of our investment professionals to help you navigate your financial course across the changing investing environment. We are grateful for all of your notes and comments, and we try to respond to as many as we can. Please keep those emails and messages coming. We'll be back with you next week. Until then, take care, stay safe, and stay healthy. Thank you for listening to the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Hightower Advisors, LLC, Farr, Miller & Washington, or any of its affiliates make no representations or warranties expressed or implied as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC, or any of its affiliates assume no liability for action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC, or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC, or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented to entity as tax or legal advice. Clients are urged to consult their tax and/or legal advisor for related questions.